Good evening. This is Ken Long from Tortoise Capital with a review of the market health check for June 28th, 2013. So we're looking at S&P on the 28th of June, daily charts going back about 4 months. The vertical blue lines represent 10, 20, and 30 days of look back. The horizontal purple lines at 167, 164, and 161 represent price targets that have been resistance before, and which, if we get through that, is a positive sign. The horizontal red lines are support levels that have held in the past and which, if violated, point the way towards failure to the next red line below. So that's our little price ladder for support and resistance at key price levels. The shaded blue, dark shaded blue area is the river, 30-period Bollinger Band plus or minus 1 standard deviation. The lighter shaded blue is the floodplain, the 2 standard deviations on a 30-period Bollinger Band. Thick black line in the middle is the 30-period regression line lagged by 1 day. The outer black lines form the RAF regression channel created by the maximum excursion from the regression line during the look-back period. We lag that 1 day to see if today's price action falls outside of that channel in order to determine if something materially different happened today compared to the last 30 days of normal behavior. Today it is inside that channel, very near the regression line. So today was just more of the same. It's completely consistent with the current pattern that's represented by that regression line and channel. Thin red line in the middle is the 30-period simple moving average, the Bollinger Band mean, the midpoint of the river. 50-period moving average here. This thin black line is the time series of the slope of that 30-day regression line through time. And you can see that it's sloping down, and that generally forms our opinion of the immediate trend of the market. And you can see how far it's fallen from the swing high up around 167. Williams percent R here, we're coming out of oversold conditions now at the midpoint at minus 50, right in the middle of the 10-day trading range. Percent price oscillator has had an extended downward move over the last 30 days and is just about closing the jaws right here as it approaches the zero line, which suggests that maybe this leg is down. And because we have price entering the river right near the regression line, we can say that this is, and at the 10-day moving average too, we can say this is a natural turning point. We're in the middle of a tactical trade, that it's got to get above 167 to be really considered a resumption of the bullish trend that's taken this from 135 to 168 over the last year. Equally, we have a move down to 150 in the 200-day moving average. You can see in the shaded area in red here. So we're right in the middle of that trading range, and this is very, very tactical trading. This harsh sell-off, which came out outside of the floodplain, more than 2 standard deviations below and starting to hook back up, would normally consider a return to the mean to be the natural play. So still a couple bucks on the upside there. But what's of concern here is that this Bollinger Band mean slope, which has been unfailingly up for the last 5 months, has now rolled over, and the 30-period regression line has crossed over that Bollinger Band mean, and so that is a cause for some concern, because that marks what could be a intermediate term swing high, which has now failed significantly 1, 2, 3 times. It has failed to get back up to 167 and above. You can see, looking at the ADX, it's right at 20, so it's a non-trending market, but the bears are slightly in charge and got a little stronger today. Market classification is still bull volatile. So what we have right here is an extended aging bull that has suffered 1, 2 pullbacks with lower highs and lower lows, and maybe at the end of the run. It has resisted the harsh sell-off except for these 2 days here. It's still, 5 or 6% above the 200-day moving average. So this is a place where it's got to fish or cut bait, and we would, if we're going to see a bull, we've got to see prices get above 167. Certainly the Bollinger Band mean and the far side of the river are normal price targets, but that's the places where it's failed 1, 2, 3 times. And so if it doesn't even get above 165, that will sort of be an indication of the generally downward sloping nature of this market. And so the first place we're going to see is, what do we get next week? Can we get to the Bollinger Band mean? Then can we get to the far side of the river? Can we get out of the floodplain? And if we do, then and only then is it strong in the longer term. As a supplemental, what I want to take a look at here is using the free stock charts markup, which I really like. It's the same kind of sensibility here, but now this goes back about 7 months. And just some things I want to point out. I've added a 90-period regression line here in green to indicate the longer-term trend, even slightly longer-term trend than the Bollinger Band mean. On these legs up in the bull, I want you to notice that the pullbacks came to the Bollinger Band mean or the bottom part of the river, only briefly touched it, and then took off sharply in each case 1, 2, and 3 times to make significant moves to the upside. Quickly reversed direction, got across the river and out, and then into the floodplain and beyond. This fourth time, however, it actually never got back out of the river. It kept mucking around here near the Bollinger Band mean, and then failed in a big way out of the river, out of the floodplain, and beyond in this blue circle. So it wasn't really a pullback at all, but it was really the first significant breakdown in the last about 5 months. So we've got lower lows, a sharp move out on increased volatility, which has caused the Bollinger Band mean slope, the red line, to go negative for the first time in months. You see, during this entire period, those corrections barely moved the slope of the regression of the Bollinger Band mean, and certainly regression line. A little bit earlier, even before this sharp sell-off, which is what's so awesome about the 30-period regression line, was that this weakening pullback here was so weak that it actually caused the 30-period regression line, the black line, to adapt and then cross back over the Bollinger Band mean. When that happens, that we can sort of put an end point to this long bullish move all the way to the top. This is quite often an indicator of the start of the next leg on a swing term basis, and so far we've seen that kind of follow through with a sharp sell-off, return to the edge of the river, and then Friday's price action was disappointing for those who wanted to see that as buy and dips, because it made a lower high and fell slightly out of the river, whereas you would want it to see it get back to the Bollinger Band mean and beyond. So now we've got the Bollinger Band mean sloping downward, price out of the river, both regression lines outside of the river. That's the definition of the beginning of trending behavior to the downside. And that's really has started occurring over just the last week. So let's see what we can get next week. Are we going to get to the mean, to the far side and above 167.5, or is this going to be a series of unfavorable events, a series of unfortunate events? So clear warning signs for us now. Slope is down. RL90 has rolled over. The RL30 has crossed the Bollinger Band mean. Price moved well outside of the floodplain. Failed at the edge of the river here on it's a one-day failure, but still, let's see what we've got. We've got beginning of downward trending behavior based on both regression lines and price are out of the river, all pointing downward. So that's the market health check. It's a tactical market for shorter-term traders. Lots of volatility and interesting moves in the equities and in gold and silver today too. So it's Ken Long from Tortoise Capital. Keep your powder dry and your risk measured.